Neither Better Trades or any of its personnel are registered broker-dealers or investment advisors. I will mention that I consider certain securities or positions to be good candidates for the types of strategies we are discussing or illustrating. Because I consider the securities or positions appropriate to the discussion or for illustration purposes does not mean that I'm telling you to trade the strategies or securities. Keep in mind that we are not providing you with recommendations or personalized advice about your trading activities. The information we are providing is not tailored to any particular individual. Any mention of a particular security is not a recommendation to buy, sell, or hold that or any other security or a suggestion that it is suitable for any specific person. Keep in mind that all trading involves a risk of loss, and this will always be the situation regardless of whether we are discussing strategies that are intended to limit risk. Also, Better Trades personnel are not subject to trading restrictions. I and others at Better Trades could have a position in a security or initiate a position in a security at any time.
Hello, and welcome out to the Insights. Going to start off with usual little quote, and this one in particular hit me because of what happened this last week in the market. And the quote says, "Our thoughts control our energy within and around us." And I know, at least for me, a lot of times, it's always fun to catch the kinds of move we had. If you're on the right side. If you're on the wrong side, it stinks, but if you're on the right side, it's a blast. Back in September was an absolute blast. 3 or 4 day, just, flash crash, mini crash, whatever you want to call it. Being on the right side of that and loaded up on puts it was just fun. And if you had puts this last week, then you probably had some fun. And so it's interesting, though, when you look at the opposite side of that. If you didn't have puts, it probably wasn't a good week. Or if you missed it, some of it, you maybe are in the woulda, coulda, shoulda mode. It's like, oh, I could have made a ton of money. And I've been there many times where you look at it and think, oh, you missed it. And there's times where, like now, where you may think you look at certain stocks that maybe you looked at last week, or you didn't get in that you wanted to get in, or you thought about getting in and you kick yourself for not getting in. The reality is that it's never too late, and a lot of times these first moves are just the beginning. So I think, and the funny thing is when I'm going through charts, I expected not to find that many opportunities for this week because of the move that we had. Funny thing is I actually found a lot more than I expected to. Even with the patterns that I found, there's, I think, more opportunities because of the crash. Some of them will have to maybe wait for a little bit, have to give it a couple days. There's several that have gone past the entry points based on the stop or the target that I put on. But there may be great opportunities later this week if they pull back. So the reality is, though, if you're beating yourself up, or if you're thinking that you missed it, if you missed a move, don't. First of all, there's nothing you can do about it anyway, right? It's already gone. So no sense in abusing yourself mentally. Just accept that it is what it is, and know that there will be another opportunity. And if it's not with a particular stock you're watching, then it might be with a different one. So the one thing I've learned over the years is to just relax and let the trades come to you. And I know it's easier said than done. So just take a deep breath, relax, and know that everything will work out just fine, just the way it's supposed to. So with that being said, let's go to here, and let me get rid of that there. And I'm going to make a little shift. Just going to look at the economic events calendar and not go through all the earnings, especially considering that Alcoa is coming out tomorrow with earnings and kicking off earnings season. And that's been taking up a lot of time. And I've kind of decided, you know what, the earnings show up on extreme charts, and those have been pretty accurate the last few seasons. So I'm going to start just leaving that and using those and saving the time for other things. I've had several requests for things to go through in the insights, looking at patterns and explaining a little bit more behind the emotional side and why the pattern does what it does and is what it is. So instead of going through the earnings and spending a few minutes on that, I figure it's better time spent doing that. So just trying to prioritize and cover what's important, what's most important. So but the economic data, looking at what's coming up this week, I think is important, and it doesn't take long anyway. So, and there's really nothing huge. And a lot of there's PPI, core retail sales, which could have an effect on the retail sector, obviously. So these could be sector specific. So if you're trading, well, Macy's has gotten just trash. A lot of the big name retails have gotten beat up real bad over the last 6-8 months. They bounced a little bit last week, even with the market getting beat up. Retail had a decent week relative to the rest of the market. So not sure if it's just a short covering or what, but we'll see. The next week or two will determine that. So PPI, well, those retail sales, that'll obviously affect that sector, but not much else. Michigan consumer sentiment, nothing significant. So let's go over a look at the charts. And again, I'm going to combine basically the market update with the big guys. I'm going to start doing all in one video instead of breaking it up into two. And you can see there, nice. I mean, it's as big as it's a drop like we had in August, and it looks like yet again, I've been talking about this for a good year, if not more, that we're looking at probably a pretty good sized correction in the market. The question is when and how far. And I can probably take these lines off here. They don't mean anything anymore. And all the signs have been there. It's been showing up over and over and over again. And we may be, I think we're finally cracking to a certain degree. And you can see there's a weekly chart going all the way back to 09. In fact, if we go to monthly, that's the crazy thing. You look at this run we've had, and you go back to the late 90s, early 2000. It is just as steep and just as long. And just like we had there, it's not necessarily sustainable forever. So there's almost always some type of correction, and the one in 2000 was very significant, relatively speaking. And then in 90 or in 07, 08, we had the same thing, and you can see right there on the chart exactly what happened. The interesting thing is the time frames are about the same. You got 6-7 years in between those crashes, and we're in that same thing. And just like I've said before, I think we're in the almost in the perfect storm where you've got the baby boomers that are starting to hit retirement age. They have been for a little while, and a lot of them have their money invested in the market. And if it keeps dropping like this, they're going to start to panic. So, and then you got the Fed, I think is leveraged, over leveraged probably. So it's almost a perfect storm, I think, for a major crash. Don't know if that's going to happen. But if it is, better to be prepared, right? So, just again, reiterating to be cautious as far as being, I'm not bullish at all in this market for obvious reasons. And I will start, especially with what's happened in the last week or two, being much more leveraged on the downside than the upside. In fact, I'm seeing a lot of opportunities for even some leaps, leap puts, long-term leaps for the next year. So maybe even all the way up to November, to the election. That could have a major effect on the market, depending on what happens in the election. So we will see. So, but obviously, you can see the last 5 days just tanked. We had a little stall out day, but Wednesday, Thursday, Friday, acceleration in volume, which obviously makes it more bearish. So we're halfway to the next target there of 1870 or so, 1867. So I wouldn't be surprised at all to see us get there this week. So it's okay. But look at the other markets. Of course, they're all looking basically the same. NASDAQ, same thing. Industrials, basically the same picture. Transport, same picture. And Russell. It's funny now, all the markets are basically in tandem. Where before it was, the transports and Russell were going the opposite. They've just gotten worse. That's all. They've accelerated to the downside even more. So they're breaking into new lows where the other markets, they are too, but not as long-term a lows. So I haven't looked at the VIX, and it's not, I remember seeing it the other day. It's not accelerating as quick as you would think it would. You see back here what happened back in August. It moved quick, even though we've had a pretty solid move. So it's hard to tell what that's going to mean. Does it mean that people aren't as scared? They don't think it's going to crash as big. The fear is not as high. I mean, clearly that's the only thing it's saying is that people aren't as afraid. So, um, but then again, I mean, just like it happened back here, you've got a 2-day move from 19 up to 50. So that very well could happen tomorrow. So we will see. We will see if that happens. So let's get to stocks. And like I said, a few more opportunities than I expected. We got 22, which is back kind of to the normal, what we used to have in the last 2-3 months with a lot of the sideways action we've had. Not a whole lot of opportunities. So we'll go through these and pop through them and see what we've got. ABBV. AbbVie, I'm not even sure what they do. Doesn't show a subsector, but like we say, who cares, right? Ticker symbol on a chart, that's all we need. But obviously been bearish for a while. We're down from what, about $70 to 55 over the last few months. The last couple months has been pretty bearish. Moved down, kind of a bearish engulfing pattern, not exactly, because typically it comes at the end of an upward move. This is, it's engulfing Wednesday, Thursday, but it's after a downward move, so not necessarily as powerful, but it's there. So just looking at this thing possibly accelerating to the downside, and far enough ahead of it that as long as it doesn't gap, or well, if it has a big down day, that's a good thing. But as long as it doesn't gap down, then we should still be able to catch this thing. So ACE, there's another one, similar situation, even less powerful with the bearish engulfing because it's only one day and it's not really even, I mean, it's moved 120 to 110 and what's that, for 6 or 7 days, 8 days. It's hard for me to get excited about these because the odds of a retracement to the upside are so high after that kind of move. I'm a little skittish. So there we go. And we're still having the issue with extreme charts, noticing that the lines popped. I went, wait a minute, the blue line is out of whack. I tried doing an update to see if maybe they corrected it, if they put out a new build, but it hasn't been done yet. So if you're having that same issue, just keep going to when you do an update, when you go down, download a special file, hit upgrade, eventually they'll come out with a new build that should fix that, I would imagine. If you're having the issue that we had after New Year's, if you type in get codes, no space, just GETCODES, and do that. Sometimes that will do it. That's what happened. That's what actually fixed mine. It took a day or two, finally came through, but it fixed it. So, but now we've got this issue. So just keep upgrading. They should have a new build out that fixes it. But getting back to ACE, yeah, not terribly excited about the downside yet. I would actually rather see it kind of dance around this line, bounce around 110 here for a couple days, take a little stall, kind of catch its breath, and then keep going. So that would be preferable there. Same thing here with ACN. Big drop, it's dropping off. We're looking at, it's sitting right at that support level, which isn't really that solid anyway. So if it breaks there, we're looking at dropping to about 91. But again, it's dropped so far so fast that the odds are it's going to bounce first. And again, I'd rather see it kind of dance around that line first before it drops off. AEP, utilities have been fairly solid. Some of them. That's what's interesting, and that's what's weird, is that oil bounced back a little bit. Some oil companies did, at least. Of course, you've got Valero that was originally on the first list, but Valero's just been tearing it up. Even though most of the oil companies have been just getting trashed, Valero's one that's been super strong. And there was it showed up some little pattern, but it didn't make the cut here. But AEP actually looks kind of bearish here. You've got several days of long upper shadows. So kind of mixed on this. This could very easily be a breakout to the upside as well. Not the most exciting bearish look here. So we'll see what AEP gives us. AGN, there's that head and shoulders from last week. So it's a rollover basically. We're looking at this. Again, it's broken down. Obviously now it's clearly below the neckline, which is good. The only thing that I don't like is the volume's not that spectacular. Yeah, it's broken down, but it hasn't sold off that hardcore. But It is below the 200-day and the 50. You'll notice all three. The 20 is crossing below the 50. The weird thing is that even though the 20 is headed down, but the 50 to 200 are headed north, and the 50 actually crossed above the 200, which is interesting, even though the price is going the opposite direction. But you'll notice that you've got divergence with MACD, and it's now turning south, starting to expand a little bit, albeit it's kind of subtle, but it's starting to expand and cross through the zero line, which is bearish. Stokes is bearish. It's pointing lower. It is down there below the 20, but it looks almost as if it wants to just bump along that line, and that's really what it could do from there. We'll see. It's hard to say. You never know until it actually takes place, but target still 284.50. So this is one that tempted to move the stop down just a little bit, but I'm going to leave it there. So we'll see what it does for us on Monday. CHD. Now this is an interesting one. Church and Dwight household products. I don't know exactly what household products they do. I don't know if that's their brand, Church and Dwight, obviously, but they've been around for a long time, so I don't know who they are. I mean, I've never heard the name, but it doesn't mean anything. There's 25,000 companies out there, probably traded at least millions. But obviously, they've been around for a long time, and they've just obviously been a nice, steady growth. But we've got on a weekly chart, you can see there's a pretty nice head and shoulders showing up, and it's just as prominent on a daily chart. About $10 of potential. The interesting part is that we have a morning star. And the morning star took place right at the neckline. The neckline breaks down just for one day, but then it bounces back up. And you can see the volume was pretty solid on Friday, moving back to the upside. So I'm actually looking at this as an opportunity to play that bounce, because you can see that neckline is pretty solid. You got 3 bounces on it before. And so even though longer term, especially if this thing gets below the neckline and stays below it, I think it's a good opportunity for a downward move. But if the market bounces on Monday or Tuesday, which is a decent chance considering how far it's sold off, pretty decent chance we're going to have some kind of short covering, or you got those people out there that are still bullish on the market that are going to come in and start buying once it gets to a certain point. And if that's the case, the market goes up, then the odds are that this will bounce up as well. So figure might as well take advantage of the bullish opportunity for a short term, 1, 2, 3, 4, 5 days. There's about $3.50 of potential there. So if it gives us a bounce, awesome. Rounds back up to that downtrend line, perfect. If it doesn't, oh well. So, but the morning star, and I figure I'll take this opportunity to go through that pattern as far as, what is it about that particular pattern. And really it is a 3-day pattern. If we're going to get into kind of the emotions behind it, the bullish bearishness, and why it's a powerful pattern. This is actually one of my favorites with respect to candlesticks for reversals, which there's only one continuation anyway. So, but essentially, and this is not beautiful. It's not textbook. And typically you would have the first day would be a down, a dark day, a bearish candle. Here we have, it is a down day relative to the day before, even though there's an open body. It's a small spinning top, but the next day gaps down. And you see the middle day right there. It gaps down from the previous day, and then leaves a small body, spinning top, doji. Any one of those works. So in other words, the second day of the pattern, the bears came in first thing in the morning. They gapped it down. The bears had control at one point, but then the bulls came back, and it's basically you've got the tug of war. That's what a doji or a spinning top is, right? It's the indecision. It's back and forth all day long, and it closes basically saying, we don't know who won. So the bears had control in the morning, and then they tied at the end of the day. End of regulation, it's tied. The next morning, what happens? Boom, the bulls gap it up. So the bulls say, hey, we're ahead. And typically a textbook pattern would be they would run it and keep it up, and you'd have a big candle. So you'd have one big dark candle, the spinning top, the doji day, and then the next day they gap up and the run. And we have the gap up here on Friday, and we had the big rally. There was a long upper shadow, which kind of negates the pattern to a certain degree, but the textbook pattern would be to have a big day. So essentially, the Bears have control the second day, and then the Bulls come back and they say, no, they tied at the end of regulation on day 2. The last day of the pattern, in this case on Friday, the Bulls came back in and said, no, we're going to win. And they pushed it higher. They closed it up about $1, and they had better volume. So it's a shift from one side having control to the other, and they won. They won by the end of overtime, essentially. Is maybe one way to put it. So Morningstar's awesome. It's a great pattern, and that's why. So hopefully that all made sense. Moving on to CHRW. This is one that, again, not my favorite necessarily, but bouncing off of a resistance level. And it's kind of bounced around there. Not the most exciting pattern or look, but we'll see. We'll see what it looks like on Monday. I mean, this is just kind of one of those wait and sees. Dominion. This is another one that looks awesome. Another bullish candidate. And again, it's a utility, which is starting to show some bullish signs. It's been basically sideways for the last year and a half, almost 2 years actually. It's gotten a little more volatile here over the last few months, some bigger swings, bigger moves. But this is also busted out in a big way with big volume to the upside. The rest of the market's getting trashed, and here this stock is going higher. But it moved a little too far on Friday to justify getting in at this point, unless you wanted to go. You could look at this and go, okay, I'm going to adjust the stop up to just below the 200-day moving average because it did cross there pretty big. It's pushing the bands a little bit. So you could adjust the trading plan. You could put the target higher up, up at that 74, 75 area where it hit before. For me, I'm just going to wait and see if it pulls back. If it doesn't, and it takes off and rallies, and I miss it, oh well. I'm not too worried about that. But if you're worried about it taking off without you, then maybe adjust it. As long as you have the odds on your side, that's all that really matters. So, Dr. Pepper Snapple. This is basically the Pepsi Coca-Cola of the last 5 or 6 years. And here's the craziness of this. It's funny, I was looking at this, and I know I've said this multiple times, but I looked at this one, and I think it's a great example of the mere fact that this market is extremely overvalued, in my opinion. Some people say it's not, and it's just hard to buy into it when you look at the overall market. You look at the picture of it and how it's run. It's reminiscent of 2000 and 2006, 2007. And here's a great example. Snapple comes out in the middle of the crash in 08. Goes public about $20, $22, and then it gets cut in half very quickly. It goes down to 10. That bounces in 09 when everything. And it went from $10 in almost 100 here in 5 years, 6 years, about 6 years, 6.5. And the question, like I've said before, is did they really, even if they were valued at $20, let's say $20 was what they were actually worth, and in 2010 they were sitting about $20, and here we are in the beginning of 16, 6 years later, and it's 5 times higher than that. So essentially, this company has grown almost 100% a year for the last 5-6 years, and maybe that's reality. But there's so many examples of these that it's just hard to buy into the fact that these things are actually valued at this price. So I think we're in a similar situation of 2000 and 2007 where these companies are overvalued. So having a put play on this, maybe even depending on what this looks like in the next month or two, if it gets more bearish and starts to show more bearish signs, this might be one of those longer term, you buy a put 2 year or a 2 year put, you buy a leap out there 2 years from now, maybe even go way out of the money to the 70, 80, somewhere in there. It could be a big payoff over a long term. And even though I'm not a long term trader, I'm starting to see some of these opportunities here that might be really good. You just take a small chunk of change and set it over there and just let it go. Just say, hey, I'm going to throw $300 or $500 or $5,000, depending on what you're working with, and just set it over there. And if you throw $500 over there, and in a year it's worth $5,000, was it worth it? I mean, I don't know. So just a thought. But so yeah, and you can see too. Here's another significant indication: is you've got pretty significant bearish divergence. Back in October, you've got a high on the price and a high on MACD, and today, even though you've had two higher price points, and not just a little bit, we're talking $5 worth, 90 to 95, and the highs on MACD not only are significantly lower, but it's very flat, and it's actually starting to move to the downside. Stokes is starting to look more bearish. So everything about this setup I love. It looks beautiful. EIX, Edison, another utility company. This is one that actually looks bearish, which is interesting. The last two, I think, were bullish. And this one could realistically go either way. It's sitting right on the support level, setting it up, at least planning for a bearish trade. If it bounces from here and takes off to the upside, might flip it over. But indications look bearish. It's sitting at the support level, so we'll see what it does on Monday. If it takes off to the upside, then maybe a flip. Otherwise, we'll look for the bear side if it breaks. EQT, here's one of those oil and gas. And you can see what's happened to these guys. See, they were 110, now they're 50. This is what I would expect to have happen with, like, the Snapple. Oil was extremely overvalued, extremely high. We were at $100 a barrel. Now we're at 30 or something like that. So it's been cut by 70%, and obviously a lot of these stocks have reflected that. And you can see same type of thing. I mean, you go all the way back to 96, nice steady growth, and this is normal. This is kind of a normal move for stocks. As companies grow, they grow relatively slowly, and then all of a sudden in 04, 05 it starts to accelerate. 06 it takes off and runs from 29.30 up to 70. It almost triples in price. And then 07, 08 hits, and what happens? 70 down to 20. And then it builds back up. And here in 13, it took off and accelerated from 62 to 110. It almost doubled in price. And you can see over the last, when did it peak out? Nice double top there. 14. So over a year and a half, it went from 110 to 55. So it got cut in half. So if this is going to happen to Dr. Pepper Snapple, I mean, what if you'd have bought when the thing was at $100? You bought the 70 puts for 2 years out. Today they're worth $20. You might have paid $4 for them. I don't know what it was. I'm just speculating now, but you pay $4 for something, sell for $20 a year and a half later. You pretty happy? But here's the interesting part: is short term, big bullish engulfing pattern on Thursday, and follow through on Friday. So it actually, interestingly enough, even though longer term it's gotten beat up, it on the short term it is extremely bullish as of right now. So we'll see what it brings Monday and what it looks like. It'd have to pull back based on this plan. I mean, you could throw together a different plan with a higher target. This one's a little more conservative, so we'll wait and see. I kind of want it to pull back and dance around that line a little bit, and then maybe look at a bullish play. So this might be something that presents itself later in the week. Ooh, Facebook. My favorite. Just kidding. There's a jump. Here's the only thing I love about this, and as y'all know, I'm a breakout trader, so I prefer the breakouts. So this is breaking down below a support, below 98.60. It broke below 100 on Thursday with big volume. I mean, it opened right about 100 and just crashed right through it. So, which is confirmation of some bearishness. The round numbers can be significant. You got a support level just below that, and it's below that. Follow through on Friday. Earnings is coming up here in a couple weeks. 27th is what? Well, it's 2 weeks from Wednesday, so plenty of time for that to drop $6, which would be a good move. And the beauty of this is, like I talked about, and it's really hard to get it to work out. I've been trying the last couple earnings season to try to figure out and master a way to be able to figure out what's what, but there really is no way, and I haven't come up with any way to systemize this type of situation where, I mean, you got earnings 2.5 weeks out. If you can get into Facebook right now and it drops to 91.76, and say you get in, you pick up, let's just say 10 contracts, and it drops off, if you can get out of 8 of them and get all your initial capital back and hopefully a profit, and leave 2 of them there and just hang on to them and see what happens with the earnings, you have the potential for a massive home run, or you have the potential for a break even or maybe just a small gain. If you pick up 10 contracts, you pay $5 a piece. You got $5,000 in. If it drops to 91.86 and you can take 8 contracts out for, let's say, $5,500, okay, you've got a 10% gain, all your initial capital back plus 10%, and you got 2 contracts still sitting there. And if earnings comes out and it's bad news, and you look at what happened last time, I don't know if that's earnings, but it dropped to 75. Well, if you drop from 90 to 75, that's $15. You're probably going to capture 12 of that. It's pretty much a grand slam. But if it gaps up and there's good news and it goes to 0, then you still made $500. So just a way to consider it. It's a possibility, something to do. Just leaves the door open for a massive, massive win, which is always fun, right? HCA. This is a rollover from last week. Big drop, 95 down to about 70. It's been dancing around there for the last 2-3 months, 4 months. This tight little range is just barely breaking down. Still hasn't made a big move to the downside, and a little skittish on it. But I think if it breaks, it's going to break and move quickly. So that's the reason I like it. We've got about $5 of potential on a $60 stock. That's pretty solid. So we'll see what happens with it. IBM. IBM is looking beautiful. See, we've been in a pretty solid downtrend. Obviously, we hit $200 of the high. Nice round number right in March of 13. So we're not quite 3 years away from that. And it's at 130 basically. So 70, it's a good 30-some% drop. So the trend, if we're going to be trading in the direction of the trend, then we're looking at a break. And the beauty is there's really almost no support. I mean, you've got November of 2010, it hit its head here at 131, and that's it. I don't think there's any more than that. No, that's it. So what we've got is, if it breaks that, which it dug in here just in November, it dug in a little bit there at 131. If it breaks there, there's really nothing to stop it from going to 117. And this is another one that has earnings. This is even sooner than Facebook, but it's on the 19th. I think that's a week from Tuesday. Yeah, a week from Tuesday. So $12 of potential. I mean, that's almost a 10% move. So could be a spectacular opportunity for IBM. So good old I've been moved, right? And L Brands. This one, L Brands, we've got the nice in bearish engulfing pattern, and this is a little more textbook than the other ones, because at least it is, even though we've been for the last month or so going sideways, at least it's up, not necessarily at the end of a run, which this right here is one. This is one that is textbook. In fact, this is about as textbook as it gets right there. Because, and getting into not necessarily the emotions of the pattern, but something that's very important with respect to candlesticks and the term reversal. And this is a beautiful, beautiful example as to why it really is important to understand that the term reversal is a misnomer. It basically just means change of direction when it comes to candlestick patterns. And this is a great example, because you look at the momentum and the run that we had there before this bearish engulfing pattern, and that would be the reason, if I was looking at this back then, I'm just using it historically as kind of a teaching moment, is that if I was looking at this bearish engulfing pattern, I would not expect it to drop from here. I would expect that with the momentum to the upside, with the push that we had, that would just create a change of direction, which is exactly what it did. We were running up for a week and a half, big time. Bearish engulfing pattern changes the direction from up to sideways, which is exactly what it did. You got a similar, I just noticed, similar kind of situation here, where except that we'd already, we ran up again a little bit after that change of direction, had another little bullish move, but then it went sideways in a big bearish engulfing pattern, and then it went sideways there. So what it means here, in fact, I would say this is even more bearish actually, because we've been going sideways, and now we've got the bearish engulfing pattern, and it has broken through what was a kind of a support level there, about 94. So decent chance that it'll drop off here to 85. Do have to be aware that there is a potential for a little slowdown here. Should put a line there. Just be aware that that's there, which coincides with the 200-day moving average. And you can see bands have pinched. We pushed into the band. So this looks bearish as well. You can see the indicators also looking bearish. You got the massive divergence there on MACD over the last few months. So everything looks good there. Lockheed. Ooh, did you see that? Look at that head and shoulders forming. I don't think I even saw that before. But it looks good here for a bearish move. Again, bands have been pinching. It's pushing the lower band. Lower band starting to drop off. Stokes, MACD, both looking bearish. And the 200-day moving average is the target. So love the looks of this. This is one of my favorites on the list. Earnings is coming up, though, on the 26th, which is, 2 weeks from Tuesday. So that is another one that, just like Facebook and IBM, may present a really good opportunity. So we'll see what they give us. Lululemon. That's a rollover from last week, and broke out of that $53 area, and it's pulled back a little bit. Even with the weakness of the market, this has stayed fairly strong. Hasn't gotten trashed or beat up. So if the market moves bullish on Monday, this very well could take off and rocket to the upside. We will wait and see. Merck, another one, rollover. It's just been drifting lower over the last 2-3 months. Quasi-bearish engulfing pattern, slight increase in volume, sitting right at that support level. So a break of that is beautiful. And this is, barring a gap down on Monday, this could be, could give us some good opportunity. Pepsi, kind of like Dr. Pepper Snapple, but not as dramatic of a run. Looking bearish. We're sitting in that support there at 97.36. It's broken just barely below it on Friday. So we'll see. If this accelerates to the downside, I think there's a great opportunity. If it bounces again, then okay. Whoops. Ross Stores. Just trying to finish up here. I know this has gone long today, but lots of potential. So again, kind of a not so spectacular bearish engulfing pattern. Now this one back here is good. And really we could look at this and say this is the starting point. We had kind of a hangman bearish engulfing pattern, which changed the direction from up to sideways, and now we've got the moves going back downward. And you can see this has been chopping around. And actually for a retailer, Ross has actually been doing relatively well. You look at Macy's, watch this. There's Macy's. It was, $75, $71 September, or no, what is that, July? So July of last year, it was $70. Today it's $35. It's been cut in half in 6 months, 5-6 months. Macy's has been cut in half. I think Nordstrom is the same, or similar. Yeah, $80, it's 46 in about the same time frame. So, what is it about Ross that's kept it up? The only thing I can think of is like the dollar stores and Walmart and the places that the value shopping. TJ Maxx, what are the other ones? I'm not sure. I think Target's even gotten trashed. Target's not that bad, actually. That's interesting. I haven't looked at all these. Marshalls. Let's see, Walmart was 88, dropped to 56. So that's been over a year's time, though. It went from 88 to 56, and it's bounced back. But So it's interesting to look at, especially the bigger retailers, Nordstrom, Macy's, and then you look at Ross, and interesting that they've held up, but that could come to an end as well. So it could be they're going to catch up. So they may or may not. But the beauty is that you've got the pinch of the bands there, and they have flared, and that is beautiful. It's sitting right at the 50-day, so if it breaks the 50-day, that could be a good sign for a bearish move. 51.68, there's some support. So if it breaks both of those points, the odds are it's going to drop off. The only concern is the 200-day moving average there, which if it breaks that too all at the same time, beautiful. And you can see Stokes and MACD both looking bearish, accelerating to the downside. So this looks bearish as of right now. So Raytheon, I call it a double top, triple top, kind of a, yeah, that's really a stretch to call that head and shoulders. Um, Really, just looking at this and keeping it simple, it's in a rectangle. It's been going sideways for 2 months now about, and it's breaking that support level there, 122. And of course, like most other companies, indicators, MACD you can see is accelerating to the down. It's been dropping off for a while now, and it's picking up a little speed and about to cross the zero line. So same thing with Stokes. It's in the middle of the range, but at least it's turning down. It's below the 50-day, crossed that Friday. The only thing that would make this look more bearish is an acceleration of volume, which didn't happen, but that may be coming. So, and it is right on the edge of an entry point as of right now. So we'll see what the action looks like on Monday. And last but not least, well, maybe it is least, I don't know, United Healthcare. And it's interesting to see this. And here's another one. This, I think, could be justified. I mean, you're talking, it was about $20 in 2009. It got beat up, and now it's 120. But United Health, along with a lot of the other healthcare companies, their profits have accelerated because of Obamacare. You force millions and millions of people into the system, and they have to buy healthcare. This is natural. But look at what's happened in the last year. It's just been chopping sideways. And I've heard a lot of news stories lately about these guys coming out saying that, the way the system is, it's not sustainable. And if they're saying that, then I'd be concerned about them. Any healthcare company, really, because if they're saying that they can't sustain this model, what does that mean for them? And there's going to have to be changes. So, I don't know what that's going to look like. It's hard to say. There's so many pieces to it that who knows what's going to happen with it. But you can see the moving averages, and Thursday we pushed the bands. Bands are flaring big time. Big bearish look. Below the 200-day clearly. Everything about it is bearish. Earnings 19th, which is the week from Tuesday, right? Same day as IBM. So looks like next week is going to be big these are just two, United Health, IBM. And usually the week IBM comes out is a big, big week. Lots and lots of other earnings coming out. So we'll see. So there we have it for this week. And we'll be coming up with some updates this week too, especially with what's going on with the market. I'll try to give a little more frequent updates during the week, and maybe might even do some intraday tomorrow. So we'll just see what happens with things. And now that they're getting excited, things are moving now. I'm getting a little more excited to trade more than before. So get some stuff moving again. So it's been real slow lately. So there we have it. Y'all have a wonderful day, great week, and we'll see you very soon. Bye-bye.